So good evening, ladies and gentlemen, and welcome to the first of two IBOR transition virtual client webinars we're hosting this month. We're now on the 1st of March 2023, which means we have 4 months left until the cessation or the loss of representativeness of the US dollar LIBOR benchmark rate. So our focus for today's briefing will be to provide a few updates as we embark on this home stretch of LIBOR remediation. And we'll also have some information that you may want to think about as you prepare for the cessation of this rate. Importantly, we will walk you through how we at Standard Chartered are preparing to support our clients for this transition. Now, before we get into the presentation, I do have a couple of housekeeping items. The session is being recorded and it has been broadcast live right now. We're using the Blue Jeans Events platform and we're sharing slides on screen. Hopefully you can see that clearly. If you're having trouble viewing the slides, please expand the screen or move the slider bar, both of which are found at the bottom of your screen. Please note that this is a client-facing session and all attendees have been placed on mute. And throughout the presentation, you may post your questions in the Q&A panel on your screen, and our panelists will address them at the end. If we do not get to your question, please be assured that we will follow up with you after the presentation. So please post the questions with your full name as well. Over the next few days, you can expect an email from us with a copy of these slides, as well as a link to the recording of this session. So keep a lookout for that email from our team. The next slide, thank you. So my name is Carmini Rambalzek and I'm the change management lead for the bank's IBOR transition program. And joining me on the call today are my colleagues Sean Zoe from our macro structuring team within the financial markets business, and we have David Gray from our conduct, financial crime and compliance team. Now, in addition, we do have a number of subject matter experts from across the bank, including from the lending and the transaction banking teams who've joined us this evening as panelists, and they'll be ready to take your questions. So again, we do encourage you to post those questions on your Q&A panel on your screen. The next slide, please. So what can you expect to get out of today's briefing session? So for many of our clients, we are seeing remediation.
You are currently muted. Please wait for the moderator to unmute you. The event is live.
Terms to remediate. Now, with the cessation or the loss of representativeness of the US dollar LIBOR benchmark rate on 30 June 2023, clients are remediating to move away from this US dollar LIBOR rate to an alternative. And the alternative benchmark that has been chosen by the industry is called SOFR, or the Secured Overnight Financing Rate. And if you have US dollar LIBOR exposures, there is some preparation that you'll need to undertake as we approach this upcoming cessation date. You can also expect to hear more on the options available for remediation of existing LIBOR-linked contracts, and this will help give you an idea of what you can expect during any discussions that you may have with us with respect to remediation. And my colleague Sean will explain this, including how to manage linked cash and derivatives exposures, for example, or finance-linked swaps. Finally, my colleague David will walk you through the latest developments in the industry and mention other IBORs or local benchmarks that are in scope for remediation as well. So with that, let's jump into the presentation. So the next slide, thank you. So this is an overview of where we are in terms of timing. By now, most of you would have assessed your portfolio to understand what your exposures are to US dollar LIBOR. Now, after you're assessing your portfolio, you'd have an understanding of what facilities would need remediation. And depending on your particular portfolio and circumstances, the next step is to agree on remediation terms, consult with your advisors in doing so, and finally sign and return the documentation ahead of 30th June cessation date. So in assessing your portfolio, you would evaluate, agree terms, sign and return this sounds like a straightforward, quick process, but it is not. It does take several weeks and months to complete this documentation. So, especially the amendments of the documentation process. So, we do encourage you to start this as soon as possible. So what are some of the points on what you might want to consider when assessing your portfolio? So for most of our clients, we've commenced engagement a couple of years ago with multiple email communications sent out. And also your relationship manager would have been in contact regarding remediation. So this assessment of your portfolio for most clients is likely to be done by now. But if you're still in the process of doing so, here are some factors that may help you along the way. Firstly, ensure that you're across the number and the type of impacted facilities that you have. Secondly, the number of counterparties that you need to discuss remediation with. For example, if you're involved in a syndicated loan, there could be multiple other parties involved. Next, you should assess whether there are any linked products in your portfolio, which may just increase that complexity a little bit more, such as loans with linked hedges. Next, are there any changes in the accounting treatment that you need to consider and complete this as part of your remediation activities? Will there be any upgrades to your system capabilities to handle the new RFR pricing? That's a consideration as well. And also whether you need to seek independent advice throughout this remediation journey, whether it's your accountants or your legal teams, but seeking that independent advice is something you may want to also consider as part of your initial assessment. Now, the factors that we have listed on this page are certainly not exhaustive, and they just serve as a guide only. So bear in mind that your assessment may include other factors, which may not be included on here, but they do depend very much on your specific requirements. So moving to the next slide. So as part of that assessment process that I just explained, you may also wish to think about considering some activities or touch points that you could leverage now to remediate your existing US dollar LIBOR exposures and to move to an alternative rate such as SOFR. So examples of these touch points where you could have the opportunity to remediate as well are here in front of you on your screen. So firstly, when you're refinancing, for example, your existing facilities, it could be that the terms of the original loan are replaced with an updated agreement. And that way, you may want to also remediate and change or amend those documents at the same time. Or you could have an annual renewal coming up, and it's in US dollar LIBOR pricing. And since LIBOR is ending, if you renew before 30th June, you would have the opportunity to consider remediating to SOFR ahead of that cessation date, so that after 30th June, you can use the facility without any disruptions. And similarly, with extensions to ensure the facility continues to function as intended, you may want to remediate now and change from US dollar LIBOR to SOFR. We have drawdowns also listed up here. And then again, if you're changing any existing agreements, such as a clause that you may want to amend, at the same time, you can look at remediating to a risk-free rate or SOFR in the case of US dollar LIBOR. So what are some of the benefits in leveraging these touch points? We've summed it up here in what we are calling the 3 C's. Firstly, it could be cost saving when you remediate at the same time. As an example, an annual renewal or refinancing of an existing facility just means the paperwork's done at the same time and any associated costs can be minimized. Secondly, there could be certainty. So in the sense that if you remediate now, then the rates are switched and you're ready to benefit from that remediated facility once the cessation date of 30th June lands. And finally, there's the convenience of executing all changes at one go, whether it is a refinancing or an extension or annual renewal, remediating at the same time may be convenient for you. So moving on to the next slide, it's worth us here mentioning some potential impacts if remediation is not completed ahead of 30th of June. So firstly, the financial impact. You may have to accept pricing based on the existing fallback clauses in your agreements, which may not necessarily be catering for the permanent cessation of a benchmark. So historical clauses have catered for a temporary cessation of this benchmark, but not all take into consideration what would happen if the benchmark ceases permanently, which is going to be the case on 30th June. So this may mean that you're forced to take on rates such as the cost of funds, which may not be ideal for you. So this is why we do urge you to assess this portfolio, speak to your RM, speak to your advisors as soon as possible. Secondly, operationally, if you're unable to utilize your existing facilities to obtain funds in a timely manner, then you may very well be restricted in your operations or the running of your usual business activities because you are unable to take advantage of the facility as was intended. And finally, as part of your portfolio assessment, it's important to consider the current agreements and allocate sufficient time for the documentation changes that need to take place. And this will just avoid any delays in completing your remediation as well. So we move on to the next slide. So at this point, I want to touch on what we're seeing and hearing across the market and what regulator expectations have been communicated across the industry and how the market's responding. So regulators have said that across the industry, there's certainly a heightened awareness to remediate US dollar LIBOR exposures before the 30th of June 2023. And as I mentioned earlier, some clients have fully remediated or are very much underway with that remediation process. So heightened awareness is certainly there. This is coupled with the adoption of SOFR as the alternative risk-free rate to US dollar LIBOR. This is picking up across the cash and derivatives markets, and therefore the liquidity of US dollar LIBOR is diminishing, with SOFR liquidity definitely ramping up. There's also an increased focus to ensure that remediation is speeding up in some deals which are considered more complex to remediate. For example, syndicated loans with multiple counterparties, which could also involve linked loans such as loans and swaps that may require alignment of remediation terms between the products. So you've got multiple counterparties, different products linked, and this can all take quite a lot of time to reach agreed amendment terms. So certainly there is a need to focus on speeding these more complex remediation deals. So these regulator expectations for market participants to complete remediation before 30th June has come across clearly from both the UK's FCA and the ARC in the USA as well, with regulators from other jurisdictions echoing these sentiments very much as well. So what has been the reaction from our market participants so far? So we're seeing progress and momentum across remediation activities beyond just early engagement. So there are now active remediation discussions underway, and remediation is indeed being completed. And this is a positive development, seeing as we have just 4 months left until the end of US dollar LIBOR. But of course, there is more to do on that front. There was a point in time where other alternatives to US dollar LIBOR were being discussed, and these so-called credit-sensitive rates, for example, were spoken of at one point. But SOFR pricing is definitely seen as the main replacement benchmark for US dollar LIBOR these days. And for those of you ahead in the remediation journey, it is important to understand that remediation is completed once you return signed documents with those agreed remediation terms. So this is really a priority for us, given that these last 4 months do not leave us with a lot of time to complete remediation. So definitely returning those signed documents is a focus too. So up until now, we have covered some key considerations for you as you assess your portfolio. And if you have a good view of these details, you'd be in a position now to consider remediation options. So on the next slides, we'll look at what those options are when remediating US dollar LIBOR exposures to an alternative such as SOFR. So in order to evaluate and agree your remediation terms, there are 2 broad remediation approaches which you can consider. Firstly, the active contract conversion, which is to amend the US dollar LIBOR contracts to reference an alternative rate. such as SOFR. So you can do this and agree on a date now for that switch in rate to take effect on as an agreed date. The second option is the inclusion of robust fallback language in your agreements, such that it references an alternative rate upon a particular trigger event. Now, the cessation or the loss of representativeness of US dollar LIBOR is considered a trigger event. So an example of ensuring you have these robust fallbacks in place on the derivative side, for instance, is to sign on or adhere to the ISDA 2020 IBOR fallbacks protocol. You can talk to your relationship manager about this or your FM sales contact. You can visit the ISDA website as well, and Sean will be covering fallbacks in more detail in a short while. Now, with both these options, your relationship manager would have reached out to you by now to discuss these further, and you would need to consider in particular how these options might look with regards to your own portfolio. As I said, each client's portfolio is unique. But across portfolios, there are some products that are commonly found. So we'll look at some of the ways we're remediating these different products which you may be holding. And we'll move on to the next slide, which we'll look at trade products firstly. So there are four main steps and components when looking at remediation from US dollar LIBOR to SOFR. And again, this is just an overview, and so it's important that you do have that right remediation option that fits your specific needs, your portfolio profile, or simply just to ensure your cash flow alignment. So for step one, what is the new benchmark you're deciding on? So it could be either term SOFR, which is typically used for trade products, which are priced on a term basis. And this is very common, as I said, on trade. Or it could be overnight SOFR, which is used for products such as overdrafts, which are priced on an overnight basis. Step two looks at how the interest will be calculated. So the preferred convention for trade facilities is term SOFR using simple interest calculation. Next, on step three, we'll look at when the new pricing becomes effective. So this is called the rate switch date, or RSD, which is usually on or before the 30th of June 2023. The rate switch date will be the effective date when the pricing of the product will switch from US dollar LIBOR to SOFR. Therefore, any drawdown made after this rate switch date will be priced on term or overnight SOFR, depending on what you've selected. At this point, you've chosen your benchmark. You know it will be simple interest in the case of trade facilities, and you've had your rate switch date in mind. Finally, will we need to apply any other adjustments? So we know that SOFR, being a risk-free rate, lacks term and credit risk premiums compared to US dollar LIBOR. Therefore, we will need to apply an adjustment spread to maintain economic equivalence. And this adjustment spread is embedded into the margin. So bringing these components together, what does that all-in price look like for trade products? So firstly, the reference rate changes from US dollar LIBOR to SOFR, or term SOFR, as the case may be. And secondly, the margin becomes a revised margin, which is that green block on the bottom right of your screen, which now will include an adjustment spread. So that is the trade product remediation at a high level. US dollar LIBOR to SOFR, and the margin becomes a revised margin, which now includes an adjustment spread. So let's move on to the next slide to see how we can remediate a loan product. So working off the same four questions or components as we did for trade, step one for the remediation of loans is to determine the new benchmark options, and you can choose between overnight or term SOFR. Moving on to step two, we start to see a difference in the options for how interest will be calculated when using overnight SOFR. So as per the previous slide, in step two, for the use of term SOFR as the new benchmark choice, we use a simple interest calculation. When choosing overnight SOFR, the option is to use simple interest or compounded in arrears. So term SOFR is simple and overnight is either simple or compounded in arrears. And in the case of compounded in arrears, we typically use a non-cumulative compounded rate, or NCCR approach, with a 5 business day look back with or without an observation shift. There's a lot of words in what I've just said. the option to apply an observation shift will affect how the rate is compounded. And this is especially applicable when there are bank holidays in the observation period. This may result in a difference when compared with the number of calendar days in that interest period. So the bank may also offer you a compounded in arrears using cumulative compounded rates, or CCR, in certain scenarios, and that needs to be assessed on a case-by-case basis. So the difference between the NCCR and CCR, well, these are just two methods that should calculate the same interest amount if the rounding method is consistent, or the interest amount has the same number of decimal places. Now, the CCR calculates the interest for the whole period using a single compounded rate, whereas the NCCR is actually derived from the CCR, and it generates a daily compounded rate, which allows the calculation of a daily interest amount. So as a result, the NCCR is preferred for loans, as it does support those mid-interest period events if they do occur, such as a loan trading activity or the distribution of interest to lenders on a prorated basis. So with all these decisions around interest calculations, you may need to assess your internal system capabilities as well to handle the changes in the calculations. And on step 3, we can also see that there's a difference in the options for the effective date of the new pricing. So this can be done on interest fixing dates either prior to or after the cessation of US dollar LIBOR. And lastly, are there any other adjustments required? Well, yes, for loans, there certainly are. We do need to add a spread, and to be more specific, a credit adjustment spread or a CAS component. And this is added to maintain economic equivalence. Now, as a simple illustration, we can see that currently we are priced based on US dollar LIBOR plus a margin. And in the future, once we remediate, we'll be priced on SOFR plus a CAS plus a margin. So using this illustration, you can see that the change is US dollar LIBOR replaced with SOFR plus CAS, and the margin may remain the same here. So that gives you an overview of the remediation of lending products, and we did look at trade on the previous slide. And to see how we remediate derivative products, I will pass you on to Sean, who's going to take you to the next few slides, and starting off with remediating derivatives. Sean, over to you.
Thank you, Kamini. Hi, this is Sean. So on this slide, you can see that for derivative products, it's roughly the same steps. Broadly, we're following the 4 steps that we laid out in the previous slide, and it looked very similar to the previous slide. The only thing I will highlight is that in the intra-dealer market, the majority of the derivative products are traded on a overnight SOFR and compound in arrear basis. And the convention there is 2-day payment delay and no observation shift, and no look back. So it follows a slightly different convention than the loan products, and that's what dealer would trade with each other in intra-dealer market. So when we hedge the risk, that's what we use. When clients have derivative products on their book to hedge their loan products, sometimes we want to match the convention. So in that situation, usually the derivatives are more flexible. So we can change the conventions we use on the derivative to match that on the loan. So we have the same interest expense in each period. And you can see that it's the bottom illustration is similar to the previous slide, that you basically take the SOFR level plus the credit adjustment spread and the original margin. That will get you to the roughly the same economics as before. We have very little change in economics. On to the next page, I will expand a little bit more on considering the 2 different approaches that you can choose to calculate the credit adjustment spread. Recall that the credit adjustment spread is basically a number that brings the SOFR number that we're using now to the LIBOR. LIBOR was a credit risky rate that incorporates some credit spread that reflects the fact that banks can go out of business and it can fail to pay. So there is a credit component in there, but SOFR is a secured overnight lending rate, which is considered risk-free. So there is no credit spread there. So there are different ways to reflect it. One is to look at the forward-looking market. The basis swap spread will give you the conversion from LIBOR to SOFR. Or we can look at the historical measure. The most common one is the 5-year historical medium spread that was agreed by all the major market participants as a fallback in the ISDA protocols. So the top section, you can see that when we use the forward-looking basis swap spread, it can differ for different products and between different banks. It's because the moment that the interdealer market switched to SOFR, there's not a very active market for these basis swaps. So every bank will look at their risk management parameters, their positions, and come up with the most appropriate rate for the product we're looking at. So if you're looking at lending facilities, trade facilities, it will fit different banks differently. So one bank may like it more than the other. So you will see different levels from different banks. And there is not an active market between banks to manage this risk. So most of the time, it will be warehoused as a risk on the bank's balance sheet. So it's very common that you will see different banks quoting different levels. And also, it's at the end of the day, it's still a market. So you will see that level fluctuate over time. There's no guarantee that you will get better level if you wait. And there's no guarantee that it will stay roughly in the neighborhood of the historical measure if you wait until the last day. In fact, I would say that it's probably best if you do it early so that there's still time to see if the level improves in your favor. And the bottom is just the historical approach, CAS. The level is calculated based on the 5-year historical median that everyone agreed on, and that's going to be used for all the existing trades that use the ISDA protocols. So if you go to the next slide. So here is another illustration of how you can lock in your preferred CAS. So on the top, it's an example where you can compare the two, the market-based versus historical-based on November 10th, 22. And the bottom is if you compare the two on January 10th, 23. So you notice that the historical CAS will not change. It's always the same level. It's agreed by all the participants, and it's fixed, and it's not going to change. But the top one, the forward basis based on the market, will change. And okay, like I mentioned, it will differ between different banks. So you can check with different banks, see which one is the most favorable to you. But the point is that it will change and can be higher than the historical level or lower than the historical level. There's no guarantee that it will be any specific number. So there's a risk of involved in doing that. And because we are working with a deadline with this year, so there isn't infinite time for you to wait and see how it plays out if it moves in your favor. So that's definitely a risk that's out there. So I would advise all the clients to do it early if you can, because there isn't a lot of benefit in waiting here. And on the next page, we have also shown a time series of how this forecast varied from day to day and how that compares to historical. You can see that sometimes it's higher, sometimes it's lower. Of course, if you're paying, you want this spread to be lower, but if it happens to be higher, there's no guarantee that it's going to drop below the green line. So so here you can choose to lock in the rate now, or you can wait until June 30th, 23. So on that day, it will sort of have to trade at the rate on that day, and you may just end up trading at the historical level regardless. And I would say when you think about the market participants, when the market fixes on the historical rate, there's really no incentive for anyone to deviate much from that rate. So the expectation should be that this market rate should be somewhere around the historical rate. And how far away from it, and for how long and how much you can do at those levels, those are driven by the individual bank's risk appetite and risk management parameters, and how much have they done in either direction. So it's all really dependent on the client activities that each bank see. And like I said, there's no guarantee that it's going to be higher or lower than the historical rate. So that's on the fixing the CAS. So on next page, we'd like to talk about a few ways to match the loans and swaps on your book. Like I mentioned, when you look at the loans, the default is that you look at compounded SOFR paid in arrears, and there is a 5-day look back, and no observation shift and no payment delay. So that's the convention that loans will use, but that is not the same as the convention that swaps will use. Right? The swap, if you just leave it to the ISDA protocol, will have 2 business day payment delay. So you will probably have some mismatch in the loan and the swap if you leave both to the default. So how we propose to solve that problem is that if you have a loan and you have an existing swap as a hedge, you want to match the cash flows. So you will probably keep the loan as is, so use the default, and match the swap convention to the loan convention. Because like I said, usually the swaps are more flexible in terms of what convention we use. It's very common that we see, if you have a loan that's tied to 5-day look back, no payment delay, we can absolutely do that on the swap. If you have a loan that's tied to term SOFR, we can absolutely use that on the swaps. But one thing to note is that term SOFR is still a product that is subject to a lot of restrictions, i.e. the banks cannot trade the term SOFR products among ourselves. We cannot trade the product with another dealer. We cannot risk manage with another dealer. So if we trade a term SOFR swap with a client, we have to hold that swap until the maturity. So we cannot manage the risk. We cannot get rid of that risk. So we'll price the levels with the spread on top of the compound SOFR level. So you might see different banks with different spread when we quote term SOFR, because we can't manage that risk among ourselves, among dealers. And we also need to make sure whoever we're trading with the term SOFR is a end user of the product and is not engaged in speculation in that market. So we usually go through some approval process to make sure that's the case. For now, that is the regulation. We don't think it's going to be the regulation forever. So we are sort of limiting the tenor of term SOFR swaps that we can offer. For example, right now, we cannot go all the way out to 30 years for some of the term SOFR swaps, but we don't expect that to be the case forever. And when the regulation change, when we are able to trade that with another dealer, I would expect the product offering to be expanded in that space. So that's where we are, and that's how we propose that clients should think about matching the loans and swaps or any hedging. If you have an underlying product and you have a swap as a hedge, it's usually best to match the conventional swap to that of the underlying product. So on the next page, it's sort of the point that Amini highlighted. There are, broadly speaking, two ways to think about remediation terms. One is to use fallbacks. That runs into problems when you have hedging products, underlying and a hedge. They might have different fallback conventions. And there's also the active remediation. You can choose to talk to the bank, figure out what's the right convention for you, and use that with agreed language. So in that case, probably need to reach out to your relationship manager and talk about your needs. And we have seen a lot of different specific use cases that will require a little bit of deviation from the standard. If we understand your needs, usually we're able to accommodate it. In very rare cases, we might find it challenging. But most of the time, if we see that your requirement comes from a place that is well justified, we can take some risk in offering the product to give you the right convention, but leave some residual risk for us. For example, we've seen clients with requirements that says they need to have a payment delay of more than 5 days because the borrower is in a jurisdiction where the central bank requires a few more days to think about this and approve the money flow. So there's no readily available product in the market that we can use to hedge it, but we look at the situation and say the requirement is coming from a real requirement because of the product that the client has. So we are willing to accommodate the client and warehouse some of those risks. But it's always better to start talking about it early on. Now we have a few months left. Really, there's no time to waste to talk about it. So on the next page, I guess that's a summary of what we have talked about. With just a few months left until the June date, it's best to it hopefully have gone through some of the steps, but I think now the priority is to agree on the terms and return the documents so that we can move on with the remediation. So with that, I will pass on to David.
Great, thanks, Sean, and thanks everyone for joining today. By way of introduction, my name's David. I've been working as part of Standard Chartered's compliance team, looking at LIBOR transition from a conduct lens. As we've mentioned, the next couple of slides will talk to the status of US dollar LIBOR following the 30th of June 2023, as well as some other local IBOR rates. So what is confirmed is that all US dollar LIBOR settings will either cease or lose representativeness after the 30th of June 2023. Along with this, a number of other local LIBOR rates, many of which rely in some way on US dollar LIBOR in their calculation, will be ceasing, and these are highlighted in the table on the right-hand side of the screen. So these are Mumbai Interbank Forward Offer Rate, or MIFOR, the Philippines Interbank Reference Rate, or FIREF, Singapore Swap Offer Rate, or SOR, and finally the Thai Baht Interest Rate Fixing, or Thai Baht Fix. If you've already adhered to the relevant ISDA IBOR fallback protocol, as a safety net for your existing derivatives contracts. These will move to the rates mentioned in the fallbacks rate column in blue. So as noted on the slide, these rates are intended as temporary fallback rates and they're not for use in new contracts. If you're looking to remediate your existing contracts to an alternative rate, or instead looking to transact in new contracts, you may refer to the replacement rates column in green. You may also apply the same remediation considerations we've just been through when you're assessing your options to remediate any existing contracts referencing these local rates as well as US dollar LIBOR. Please do reach out to your relationship managers who can discuss with you in more details on how to remediate your specific contracts. Coming back to US dollar LIBOR, you may have noticed throughout the presentation that we've included a contingency in respect of the potential loss of representativeness for the 1, 3, and 6 month US dollar LIBOR settings. In respect of these three tenors, you may also have heard about a consultation from the Financial Conduct Authority, or the FCA, in the UK to continue publishing these using a synthetic methodology. We'll discuss this more on this slide here. So first of all, in this regard, we'd like to highlight that regulators globally have emphasized that synthetic US dollar LIBOR is not a remediation option to be relied upon. Any synthetic US dollar LIBOR rate, if it is published, would be intended as a limited off-ramp for tough legacy contracts that have been unable to actively remediate or incorporate relevant robust fallback arrangements. As mentioned, the FCA have consulted about the potential publication of synthetic US dollar LIBOR for the three tenors and have indicated that the consultation results are likely to be announced around end Q1 or early Q2 of this year. Regulators around the globe continue to encourage market participants to actively remediate their impacted exposures before the 30th of June 2023. The calculation methodology proposed for synthetic US dollar LIBOR in the FCA consultation is to replace references to US dollar LIBOR in contracts to CME term SOFR plus the historical approach cash, as we've mentioned previously, for the same tenor. This is very similar to how we'd calculate the rates if we convert to term SOFR pricing, which as mentioned can be done now through active conversion. So having run through all this, what does this mean for you and what can you do now? In line with the regulator's stance that we should look to actively remediate, we'll work together with you to help you identify the suitable SOFR pricing as we've covered earlier for your impacted exposures. We'll then share the revised documentation with the agreed SOFR pricing via signing and look to complete the remediation. I'll now hand back to Kamini, who will summarize the next steps.
Thank you, David. So plenty of information shared here, and as mentioned, you will receive the slides as well as a recording of today's session. And of course, if you have follow-up questions as well, please reach out. So final takeaways for you. With the cessation date fast approaching, I think we've all sent the message loud and clear that the time to act is now. You need to assess your portfolio, choose your remediation options, talk to your relationship manager, and get the ball rolling. You can also lock in your rate switch date now, which will in turn lock in your preferred adjustment spread or your CAS or CAS at the same time, and agree the terms with your RM as well. We did stress as well the importance of allocating sufficient time in your planning to draft and sign the relevant documents, and of course return those signed documents to us. And finally, seek your independent advice where necessary, for instance, with your accountants and legal teams as you may require. So with that, we have come to the close of the slides that we wanted to present to you this evening. And we do have a number of questions which we will now proceed to answer. So I will start at what is now the bottom of my screen. And as I mentioned, we have a number of panelists that joined us this evening from across the bank, so across the lending, transaction banking, and financial markets business, but also from our legal and compliance teams to support any questions that you may have. So I'll start at the bottom. The first question that I can see on my screen is, can I select a date that is after the 30th of June 2023 as my conversion date for my trade product. So can I select a date, so presumably a rate switch date, that is after 30th of June as my conversion date for trade products? And I have my colleague Gautam from our trade transaction banking team that's on here. Gautam, can I pass that on to you? I know you've written a very thorough explanation here, but I'll rather let you verbalize it. Over to you.
Sure. Thanks, Kamini, and hello, everyone. See, the short answer for this is our recommendation is that you take the rate switch date within 30th of June 2023. Simple reason for that is to ensure that there is, the business continuity part of it is quite seamless. Because if you have the rate switch date as something beyond the LIBOR cessation dates, there can be a period of, no drawdown request could be entertained if your rate switch date is after the cessation date, and that can have some impact on business continuity. So our recommendation is that you have the rate switch date well within the 30th of June 2023. And given the fact that you can actually offer a future rate switch date, the transition for you from LIBOR to term SOFR or any other agreed alternatives also would be fairly seamless in from that perspective. Yeah. Thanks, Kamini.
Thank you. Thank you for that, Gautam. Next question is around a syndicated loan. Will I have a single figure for CAS or the credit adjustment spread rather for a syndicated loan? Will I have a single figure for the credit adjustment spread? Short answer is yes. And Arti from our lending team has responded. Arti, I don't want to read out what you've got. Is there something else you wanted to add to the answer which you put on there?
No, I think we can go with yes on that one, Kamini. I think we've got a similar question on this, so we can cover it up in the next one.
I see. I'm still making my way up my screen, so thank you. There was another question asking about, somebody says that I've missed the reason why you can't offer the term SOFR swap and assume it was regulation. If so, why the differentiation by the regulator between the hedging of compounded and term SOFR? Sean, I'm going to bring you in. You did explain a little bit on how the team will manage term SOFR on the swap side. Did you just want to pick that up, please?
Sure, yeah. So a little bit of history. In the first place, the regulator wanted to push the whole market towards the compounded SOFR route. So they didn't want to use or allow term SOFR at all. But after a while, because there was a lot of legitimate use case, there was a lot of demand for term SOFR, they opened up the use of term SOFR, but they didn't want to create the possibility of manipulation, because if you recall, the reason why LIBOR was it posed a lot of problem because it was surveyed rate and it was based on not real trades. So if you look at the term SOFR, it's sort of a expectation of future rates, and there is some element that's similar to what LIBOR had. So the regulator initially was trying to just use compound SOFR, but after some discussion with the market, they start to allow term SOFR, but only on a limited basis. So they didn't want dealers to offer these products to clients and also be able to facilitate speculation. So they limit the use of term SOFR to only those who have a legitimate use case, who have a legitimate demand for term SOFR. So for now, the regulation, not regulation, but the advice or called the recommendation of the regulatory body is that the dealers should only trade this product with end users and not between dealers. But I think that kind of recommendation also creates its own problem, because you can see that the pricing will start to diverge between the two, and that becomes a cost for end users. Because if you want to use term SOFR, most likely you will have to pay more than if you were to use compound SOFR. But that's the current regulatory framework, and that's what we're operating under.
Yeah, thanks. Sorry, if I could add there to the point. So the the guidance kind of referred to there by Sean, so is encompassed in the ARC best practice on use of term SOFR, and as Sean mentioned there, that guidance limits the use of term SOFR within the derivatives market to hedging of end user term SOFR cash exposure. And as mentioned, there's also the interdealer limitation. And the ARC have kind of provided a variety of reasons about around that. Most notably, the intent behind that is to avoid use that's not in proportion to or detracts from the depth of transactions in the underlying derivatives market that are in themselves essential to the construction of the term SOFR rate itself. So yeah, just a bit more context there, and to highlight that the bank's offering in respect of term SOFR is driven by the ARC best practice guidance.
Thanks, David, and we will include the links to this ARC best practice guide in the pack when we circulate that later this week as well. I'll move on to another question. We've had a couple of questions on the CAS or the CAS, and the next one here is, if I'm looking at the two CAS rates today, can I choose a historical for both the loan and the swap? And I think the short answer here is yes, you can. Artie from our lending team has responded and said you can use them. The ISDA CAS is or the forward basis swap, but you can decide this depending on your particular situation and speaking to your relationship manager. I'll just move on because we've got quite a number of questions coming in. There was another question, Artie, that you've responded to as well, around, is it easier to align the loan to the swap or the swap to the loan? And I guess that very much depends on the preference for the convention, whether we're adopting on the loan or on the swap. Is there anything else, Artie, that you just wanted to verbalize here, so people don't have to read what's written on here? Something that you wanted to talk about in terms of whether loan to swap or swap to loan? And Sean, I'll bring you in too if you wanted to.
Sure, thanks, Kamini. Like I was saying over there in the response, this is really dependent on what is your preference on accounting standards which is best sought independently, and the extent of alignment that would be required in the conventions. There is a very marginal difference when it comes to the conventions, wherein the swap market that follows the ISDA convention of 2 business days settlement, look back and settlement, is slightly different to loans, which is coalesced to accept 5 business days of look back. So it is a very marginal difference, and that's something that you need to assess independently to say to what extent you want that alignment, and that would then indicate or tell you which one is easier to adopt for you, loan to swap or swap to loan. From a general market practice, we usually see 5 business days look back being adopted in such cases. That's about it, Kamini. Back to you.
Thank you. Thanks. I'll move on to the next question, which is around the protocol. If I've adhered to the protocol, does that mean I do not need to do anything further for my portfolio of swaps? So adherence to the protocol, the ISDA protocol, will I not need to do anything further? Simon from our financial markets legal team is on. Simon, can I pass this question on to you, please?
Sure, thank you. From a regulatory perspective, the protocol adherence is sufficient. However, from an economic perspective, there may be a preferable way of doing things, in which case it may be advisable to approach the bank for an active remediation in that scenario.
Simon. Next question is on the use of term rates. Is the use of term rates the norm for trade products? And Gautam has answered here that trade products are typically short-dated and they have a dependency being priced on the forward-looking rate. So they're similar to SOFR. They're similar to LIBOR in that term SOFR does offer that cash flow certainty because of its forward-looking nature. So for trade products, short answer, yep, it is preferred that we use term SOFR. The next question is, what can we do if all the lenders in a particular syndicated situation agree with term SOFR, but the swap provider can only go with a daily SOFR? So we've got term on the loan side, and swap on the swap side, we've got the daily SOFR. So RT or whoever's unmuted themselves, take the question. Thank you.
Hi, it's Sean here. So if your loan has term SOFR exposure, then we can offer term SOFR swap. The capability in that space is not very, it's uneven, I would say. Not every bank can offer the same suite of products because we are looking at different tenors, different maturities. So it's possible that the particular bank that's working as your spot provider cannot accommodate your need. But if you reach out to more banks, most likely someone will be able to offer that product to you. Assuming that it's not like for us, we're not offering anything longer than 10 years. And we only offer the typical terms like 1 month, 3 months, 6 months. But so it really depends on the specifics of your loan and the tenor. But I would assume that someone will be able to offer this product.
Thanks, Sean. We do have a question here from Ms. Manuparan Chaudhry around what if I have a 6-month LIBOR-linked loan and rate fixing date is 29th of March 2023? Can we wait till September of 2023 to switch to SOFR? As all us presenters have mentioned on throughout this evening's presentation, the recommendation is very much that you remediate the facility now, and any conversion terms that you agree on can be applied on your interest reset date after the 30th of June 2023. So, as I mentioned, many benefits to agreeing on conversion terms sooner and remediating as soon as possible. And if you've got a particular facility that has this sort of computation to it, would advise you speak to your relationship manager as soon as possible to work out your specifics for your particular portfolio. We've got a minute or two left, and I'm just checking to see if there are any more questions on my end. As I said, the email address that you can see on your screen is where you can reach us readily with any follow-up questions that you may have. We will be sending out the slides and a link to tonight's recording. And we are having a second session tomorrow afternoon, Singapore time at 3 p.m. You will find details of that session on our LIBOR page on se.com. So if you wanted to register for that or mention it to other colleagues in your business, and yeah, you're welcome to join that session tomorrow. It'll be the same slides, nothing different, just for a different time zone. I don't see many questions on my end, so with that, I might just thank our panelists and also my fellow presenters who've joined me this evening. I think it's been a good discussion and lots of good questions from all of you for participating as well. Thank you. And if you've posted any questions anonymously and we've not been able to respond to it, then again, just email us and we're happy to help on that. Other than that, I think that brings us to the end of our session. Hope you have a great day, rest of day and evening, and thanks to our Singapore colleagues for staying up this late as well. Thanks everyone and have a nice evening.